What if I told you that most small business owners hand the IRS thousands of extra dollars every single year, not because they cheated, but because they simply did not know what they were allowed to keep? Today that changes. I am going to walk you through the deductions and strategies that can genuinely slash your tax bill, and by the end of this video, you will never look at tax season the same way again. Let us start with the deductions hiding right in front of you. First up, the home office deduction. If you use a dedicated space in your home exclusively for your business, you can write off a portion of your rent or mortgage interest, utilities, insurance, and even internet costs. A lot of people skip this one out of fear, but if the space is genuinely used for work, it is completely legitimate. Next is your vehicle. If you drive for business purposes, you can deduct either your actual expenses like fuel and repairs, or use the standard mileage rate. Either way, money you are already spending can come right off your taxable income. Here is one people constantly overlook: business meals. When you sit down with a client, vendor, or business partner to discuss work, that meal has deduction potential. The key is documentation. Who was there, what was discussed, done. Now let us talk about something that genuinely surprises people. Self-employment tax. Unlike a regular employee whose employer covers half of Social Security and Medicare taxes, you as a business owner pay the entire 15.3% yourself. On $100,000 in profit, that is over $15,000 just in self-employment tax before income taxes even hit. This is why your business structure matters enormously. If your net profit is approaching or exceeding $80,000 to $100,000 annually, it might be time to explore electing S-corporation status. Here is why that works. As an S-corp, you split your income between a reasonable salary and a distribution. You only owe self-employment taxes on the salary portion, not the distribution. That split alone can save you several $1,000s per year. But before you rush to make that switch, hear this warning. If your profits are still relatively low, the added costs of S-corp compliance, including payroll and more complex tax filings, can actually cost you more than you save. Timing this decision correctly is everything. Now for the sheltering strategies. Retirement contributions are one of the most powerful tools available to business owners. A solo 401k can allow you to shelter significant pre-tax income away from the IRS while building your future wealth simultaneously. Health savings accounts are another underused gem, giving you a triple tax advantage when paired with a qualifying health plan. There is also the qualified business income deduction, a 20% write-off available to many business owners simply for being classified as one. On $100,000 in qualifying income, that could mean a $20,000 deduction, but it does not apply automatically. You must claim it. And do not sleep on education expenses, professional fees, advertising costs, and even hiring family members. These are all potentially deductible when structured correctly. Here is the real strategy underneath all of this. None of these deductions matter if you are not tracking your numbers consistently throughout the year. Set aside 30 to 40% of your net income monthly for taxes. Open a dedicated savings account for that purpose only. Work with a bookkeeper who understands your specific industry. The business owners who win at tax time are not the ones scrambling in April. They are the ones who treated tax planning as a year-round habit. Start now, stay consistent, and drop a comment below telling me which deduction surprised you most. And subscribe because there is a lot more coming your way.